first, why a big dividend, which a lot of you have been lured by, does not always pay, and the number that you actually should be watching.
Lee Munson is founder and chief investment officer of Portfolio. He's also author of Rigged Money, Beating Wall Street at its Own Game. Wouldn't that be nice? All right, Lee, first of all, what's better than a big fat dividend?
I think you have to worry about where that dividend comes from. I'm more concerned about cash flow. And I think the dividend is really irrelevant. If you look at where the companies actually get their dividends, a lot of high dividend paying stocks are actually getting that from, say, borrowed money or money that they don't have in earnings. So let's take a step back and think about where we can get a high yield, but not necessarily from dividends. REITs are a perfect example. The way a REIT's structured is that they're paying out the rents that they get from commercial properties. So, for instance, a lot of Americans out there can't get their homes refinanced, but there are some healthcare REITs out there that can get billions of dollars in lines of credit, have no problem financing, and basically you get the rents on those hospital and nursing home properties. And I think that's a much more sane way when you start looking at things getting into the 4, 5, 6%. It has about the same risk of small caps and a better return.
And a lot of these healthcare companies and maybe big corporate America REITs are also companies that take out long-term leases. So you're hopefully guaranteed on that. But aside from not really liking dividends, you do make an exception when it comes to a typical stock that pays out a dividend. And it happens to be a name that hiked its dividend today, and that's AT&T. Why?
You know, I like AT&T because it's really the anti-stock. I always warn people, if you have a dividend that's more than 5%, I'd really be suspicious. AT&T is kind of the only thing out there that I would say, except AT&T. They're a tremendous fixed asset. They're a big cash cow. They've been raising dividends steadily since 1985. But here's what the trick to AT&T as a high dividend payer. It's not really designed to appreciate. If you look over the last 10 years, the stock really has done nothing, but it has been able to pay that consistent dividend. And I think that's more important than trying to find a company that's going to give you the best of both worlds. You're setting up to too high expectation.
All right. Now, Lee, we're all supposed to keep emotions out of trades. Very often that's hard to do. But you actually take that to an extreme, and you say you have bought stocks that you hate. And one of those is when you're talking about pharma companies. In particular, Pfizer interests you right now. First of all, why do you hate pharma companies, and why would you go for Pfizer?
You know, I think that the big pharma companies are dull. They lack innovation. They have issues with patent rights, and they're always under attack by the U.S. government or getting lobbyists to do their bidding.
So why buy Pfizer?
Well, number one, it's been going up. Number two, stocks get priced on the margin, as they say. So let's say we get the news that Lipitor is going off patent and they're expecting a 20% drop in sales. Well, if those sales drops are only 15%, then a lot of value managers up there will bid up the stock. Pfizer's a tactical play versus something like AT&T you might own for decades. So I'd say that keep your emotions out of it. Look at where things are not going to be part of the business cycle next year. We've got some serious issues in Europe. We know what the issues are. You guys cover that. But look for a stock that's more insulated, at least psychologically, from the business cycle. Big pharma does that. The expectations are so low, the dividends are reasonable, they have a lot of cash, and quite frankly, they don't have to do much to keep that stock moving up. So I'll hatefully take the profits.
That's right. Buy what you hate. He hates pharma, but he likes some of these names here. Okay, you've mentioned AT&T, you've mentioned Pfizer, but let's talk about your largest holding, and that is a master limited partnership. You like these MLPSs, and I need you to tell me, how do I play that? Is there a name out there? Is there sort of an ETF? What's the best way for our viewers to play master limited partnerships that you like so much?
I think if you're not an expert in the energy field, you need to look at exchange-traded notes or exchange-traded funds. My professional opinion is there's a JP Morgan exchange-traded note. The ticker symbol is AMJ. It gives you a wide variety of basically all the master limited partnerships. Now, for viewers out there, we have to remember, what are these? It's mainly dealing with the pipelines. You're transporting black gold. 62 years ago was the last time this country was exporting more oil than it was importing. And this year, we did it. we actually are exporting more oil than we're taking in. And so I think that make your money like the gold miners on the transportation, on the pickaxes, rather than just simply on the exploration. It pays almost 2.5 times the amount of dividends that the S&P 500 does. And if you look at the risk, it's slightly less. So much better payout, much better cash flow, about the same risk as the S&P 500. And you're in a growth industry that's insulated a lot from those things outside, like Europe and questions about where Asia is going to be a year from now.
Lee Munson from Portfolio. Good to see you, Lee. Thanks very much.